Your money isn't the problem. Your relationship with waiting for it is. In Sweden, there's a deeply ingrained financial instinct that most Americans never developed. And today, I'll walk you through 8 things Swedish households almost never buy on credit, things nearly every American wallet is currently carrying without a second thought. Stay until number 6, because it's probably in your wallet right now, and by the end, you'll understand exactly why it's quietly working against the calm you're trying to build. Let's begin. Sweden has some of the lowest consumer debt aversion rates in the developed world, and it isn't an accident or a personality trait. It comes from a mix of strict lending culture, genuine cultural discomfort with visible debt, and a version of Lagom applied directly to spending. Not the cheapest option, not the most impressive one, simply enough, paid for as you go. It helps to understand where this instinct actually comes from, because it isn't simply frugality for its own sake. Swedish banking culture has historically applied stricter mortgage amortization requirements than much of the world, meaning homeowners are structurally required to pay down principal at a real, meaningful pace rather than carrying interest-only debt indefinitely. That single structural difference shapes an entire population's relationship with borrowing more broadly. When debt is treated, even at the policy level, as something meant to be actively reduced rather than comfortably maintained, that attitude tends to filter into everyday purchasing decisions far beyond mortgages alone. There's also a quieter social dimension worth naming. Visible debt, in much of Swedish culture, doesn't carry the neutral or even aspirational connotation it sometimes carries elsewhere. Financing a lifestyle you can't yet afford tends to read less as ambition and more as a kind of quiet financial fragility, which shifts the entire social calculus around whether financing something is worth the discomfort of anyone noticing. Sweden has also moved further than most countries toward a nearly cashless, digitally transparent payment culture, where instant transfers between individuals happen constantly and visibly within social circles. In a financial environment that transparent, carrying hidden, mounting debt becomes harder to disguise even to yourself, let alone to the people around you, which tends to produce a kind of ambient accountability most cash-heavy or credit-obscured economies simply don't generate on their own. Let's look at what that instinct asks people to avoid, starting with the purchase most Americans make without thinking twice. Number 1, buy now, pay later splits on everyday purchases. Clothes, electronics, even groceries in some cases, quietly divided into 4 small, seemingly painless installments. It feels less like debt because no single payment stings, but a Swedish household would recognize this instantly for what it is: spending money you don't currently have, dressed up in friendlier packaging. The discomfort doesn't disappear. It's just spread thin enough to stop registering as discomfort at all. Number 2, a car purchased with financing, stretched past what the car itself will realistically last. Sweden's relationship with car ownership tends to favor buying what's affordable outright, or financing modestly and briefly, rather than stretching payments across 6 or 7 years to afford something larger than current income comfortably supports. A car financed that long isn't really owned for most of that time. It's rented from a lender, with the illusion of ownership attached, and by the time the final payment clears, the vehicle itself has often depreciated well past the total amount actually paid for it, interest included. Number 3, a vacation paid off over the months following the trip rather than before it. The trip happens, the memories are made, and then the bill quietly continues for months afterward, turning what should be a closed, complete experience into an ongoing financial obligation trailing behind it, resurfacing on a statement each month long after the sunburn has faded. Lagom applied to travel doesn't mean traveling less. It means traveling within what's already been earned, so the experience actually ends when the trip does, rather than continuing to extract a small, recurring cost from a memory that was supposed to be finished. Number 4, a wedding financed well beyond what savings alone could cover. This is one of the more culturally loaded ones, because refusing a large financed wedding can feel, in American culture, like refusing to properly celebrate a genuinely important day. A Swedish approach tends to separate those two things cleanly. The celebration's meaning was never actually tied to its financed size, and a wedding that starts a marriage already carrying significant debt is starting that marriage with a weight neither partner necessarily chose together, discussed openly, or fully understood the shape of until the first statement arrived weeks after the celebration had already ended. Number 5. Home renovations financed at high interest for aesthetic upgrades rather than genuine necessity. A new kitchen, a finished basement, a bathroom remodel, pursued through a loan because the current version simply looks dated rather than because it's failing to function. Necessary repairs are one thing. A leaking roof or a failing furnace rarely wait politely for savings to accumulate. Aesthetic upgrades financed at real cost are a different calculation entirely. One Lagom tends to resolve by simply waiting until the upgrade can be paid for as it happens, treating the dated kitchen as a mild, ongoing inconvenience rather than an emergency requiring immediate, expensive resolution. Now here's number 6, the one I promised, and it's probably sitting in your wallet right now, whether you're holding it or simply picturing exactly where it is. Number 6, store credit cards opened for a one-time discount. 15% off today's purchase in exchange for an account most people forget exists within a few months, carrying a balance that quietly accrues interest in the background of a wallet otherwise organized and intentional. Here's what's worth sitting with. Each one of these cards represents a small, ongoing financial thread you're not actively managing, easy to forget, easy to let slide into a minimum payment that barely touches the principal, and collectively they can represent a meaningful drain most people couldn't actually total up if asked. A Swedish approach to this particular offer tends to be almost reflexively skeptical. A discount that requires opening new debt to access was never really a discount in the first place. It was a small trade, immediate savings for an ongoing obligation, usually weighted heavily in the store's favor rather than yours. There's a specific reason these cards are offered so readily at checkout. Precisely at the moment you're already emotionally invested in the purchase and least likely to calculate the long-term cost carefully. The discount is real, so is the interest rate attached to it, and store card interest rates tend to run considerably higher than general-purpose credit cards, a detail rarely emphasized in the excitement of an instant 15% off. Number 7. Subscription-based upgrades to possessions already fully functional. Phones financed and replaced annually before the previous one showed any real sign of needing replacement. Furniture financed through rent-to-own arrangements for items that could have been saved for over a few additional months instead. The underlying pattern here is a kind of manufactured urgency, the sense that waiting even briefly for something you want is somehow a cost worth avoiding, when in most cases, waiting costs nothing except patience, and financing costs real money on top of the item's actual price. There's a particular trap embedded in rent-to-own arrangements specifically worth naming. By the time the full payment schedule concludes, the total cost frequently exceeds the item's outright retail price by a wide margin, meaning the convenience of immediate possession is purchased at a markup most people would never knowingly agree to if it were presented as a single, upfront number rather than a series of small, manageable-feeling installments. Number 8, and this is the one that tends to land differently than the rest, lifestyle upgrades taken on immediately after a raise or promotion, before that increased income has actually had time to establish itself as stable. A bigger apartment, a nicer car, a new pattern of spending, all adjusted upward the moment more money starts arriving, often through financing that assumes the new income level is permanent before it's even been tested by a single full year. Lagom's quiet resistance here isn't about refusing to enjoy increased income. It's about waiting long enough to know the increase is real and lasting before building financial obligations on top of an assumption. This particular pattern is worth sitting with longer than the others because it rarely feels like debt in the moment it's incurred. It feels like arrival, like finally living at the level your effort has earned. The financial strain it creates tends to surface later, often during the first unexpected expense or income dip, precisely when the newly expanded obligations have the least flexibility to absorb it. A raise that's allowed to simply sit, unspent for its first several months, tends to reveal far more about whether it's genuinely sustainable than any amount of optimistic planning could. Underneath all 8 of these is a single question worth asking before any of them apply, the one a Swedish household tends to ask almost automatically: am I buying this because I have the money, or because I have access to money that isn't actually mine yet? Those two situations can look identical at checkout, same item, same swipe, same immediate outcome, but they carry entirely different weights the moment the bill actually arrives. Having the money means the purchase is already finished the instant it's made. Having access to credit means the purchase is only beginning, and everything that follows, the interest, the minimum payments, the quiet monthly reminder, is a cost the impressive-looking checkout moment conveniently left out of the picture. It's worth noticing, too, how differently the same object can feel depending on which category it falls into. A sofa paid for outright tends to simply become furniture, blending quietly into daily life. A sofa still being paid off 18 months later carries a faint recurring awareness every time you sit on it, a small tether back to the transaction that never quite lets the object fully settle into being just a sofa. That's all 8. Here's a simple 2-part test you can run before any future purchase. First, the waiting test. Could you pay for this in full if you simply waited 3 more months? And if so, what is the financing actually buying you beyond impatience? Sit with that question honestly rather than answering it quickly, because the honest answer is often less flattering than the quick one. Second, the disappearance test. If this specific source of income vanished tomorrow, would this payment still feel manageable, or would it immediately become a source of real stress? This second question matters more than it might initially seem, because financing decisions are almost always made during a period of relative financial comfort, precisely the period least equipped to imagine what discomfort would actually feel like. Purchases that pass both tests are simply purchases. Purchases that fail them are quiet, ongoing obligations wearing the costume of a single transaction. It's worth adding a note on what this approach isn't, because Lagom applied to money can easily be mistaken for deprivation if it's misunderstood. This was never an argument for avoiding all pleasure, all upgrades, all financed purchases under every circumstance. Some financing genuinely makes sense: a home mortgage structured responsibly, a business investment with a clear return, an emergency that can't reasonably wait. The distinction Lagom draws isn't between financing and not financing. It's between financing something because the alternative is genuinely impossible and financing something because waiting simply felt uncomfortable for a little while. Those are very different situations wearing remarkably similar paperwork, and most of the real financial peace this approach offers comes from learning to tell the two apart. Honestly, purchase by purchase, rather than applying either extreme as a blanket rule. There's a final piece worth naming, because it's easy to hear a list like this and assume the goal is permanent restriction, a kind of financial austerity that never loosens. That was never the actual aim. Lagom applied to money isn't about denying yourself indefinitely. It's about restoring a natural rhythm between wanting something and having it, one that modern financing has quietly compressed down to almost nothing. The gap between desire and possession used to require patience by default. Now it requires patience only if you choose it deliberately, and choosing it, oddly, tends to make the eventual purchase feel considerably more satisfying than the version that arrived instantly, still trailing months of payments behind it. A calm relationship with money was never built by avoiding all enjoyment or all spending. It was built the way Lagom intends everywhere else, choosing enough over impressive, paid for over financed, and trusting that most things worth having are still worth having if you simply wait until they're actually fully yours. Tell me in the comments which number hit closest to home, and let's hold each other accountable to rethink it. If this shifted how you see your own spending even slightly, share it with someone who might need the reminder that patience is still, quietly, one of the cheapest financial strategies available. Which number are you rethinking today? Meet us in the comments and tell us. I'll see you in the next one.